Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 index, ticker symbol RUT. And as I do each and every week, I've left my lines on the chart so you can see how the forecast played out. And as I zoom into the Russell 2000, you can see that this was the day that the market report went out last week. It was Friday, and then Monday, Tuesday, and Wednesday we moved lower, exactly like I forecasted last week, with the end of this line being my target level. And on Wednesday we not only hit that target level, but we went down a little bit further before a bullish engulfing pattern showed up on Thursday. From the bullish engulfing pattern, we can obviously see that the market went right back up to resistance, which again was the point that I highlighted last week. And Friday, interestingly enough, we closed with a green candle, but that green candle has a long shadow on top, which generally signals that the sellers were putting up a fight towards the end of the week. Now, what does that mean for next week? Let's erase these lines right now, and we will draw some new lines for you, and we'll keep those lines in place just like we do each and every week, so you can track the progress and see how the forecast played out. Now, the new resistance point is going to be taken from April 26th, right here. So I'm going to draw that as my price level for a target. And then what I'm going to do is I'm going to draw a new line showing the forecast for next week. And I think that early in the week we could move up to test that resistance point, and so that end of the line is going to be my target right at resistance. And even though the markets are showing some strength towards the end of this week, I still wouldn't go full-fledged into any major long positions because there's a lot of political news that's coming out next week. We have the election in the UK next week, which could obviously affect the global markets depending on the outcome, of course. Yesterday we had the Paris Accord. We pulled out of that, so that affected the markets, I think, in a positive way. As you can see, the green candles after President Trump made that announcement. And so this is an extremely volatile time with political uncertainty ahead, and with that, investors tend to shy away and move to the sidelines. So let's take a look at the diamonds. This is ticker symbol DIA, representing the Dow 30. Now this is going to carry a little bit different weight than the Russell 2000. Obviously the Russell 2000 is 2,000 stocks. The Dow Jones Industrial Average is 30 stocks. And you can see that the alert went out last week right here where my cursor is. I'll put an arrow there for you right there. And I said that the markets would move lower. And in fact, my main conversation last week was that this gap would most likely fill. The gap filled on Tuesday. Wednesday we continued lower, not quite down all the way to the target price, but interestingly enough, look at this, I'll zoom in. You can see that the low of the day on Wednesday actually touched the 20-period moving average and then bounced with a hammer pattern. So with that said, let's go to the forecast for next week. And I'm going to erase all of the lines right here as I draw the new lines for next week. And you can see that the resistance high right here was slightly broken today on Friday. And as I look at the volume, you can see that we broke out of that high on higher volume. Now, if you've been following along with the market guys, price volume divergence is something we pay very close attention to. And in fact, when you see a green candle on higher volume, that tells us that the buyers are coming in with force. So the forecast for next week is going to be slightly higher. I think we're going to move up on the Dow early in the week. And my target price is going to be right at the end of that line. Now, as the market continues to move higher, also remember that the price divergence from the 20-period moving average, we call that the rubber band effect, that could have an impact on prices next week. So as the markets move higher, I think eventually they're going to pull back. And I'm going to put that little pivot point there so you can get an idea that next week we'll probably start to pull back a little bit towards that moving average. Now the same thing is most likely going to happen for the spiders. If you look at SPY, you can see that we did pull back early in the week like I suggested. We did fill this gap, but the S&P didn't pull back all the way to the 20-period moving average. So what does that mean for next week? It means the same thing like the Dow. I believe we can go a little bit higher only because that volume down here is showing some strength. Could go a little bit higher, but I think ultimately we're going to pull back and move back towards this 20-period moving average. This distance or divergence from that moving average is quite strong. You can see that in the past the S&P does not like to stay that far above or pull that far below that moving average. So we have that rubber band effect taking place. So again, early on I think we can move higher because of that volume strength, and then eventually I think we could start to pull back towards that moving average. Okay, if we look at the Qs, ticker symbol QQQ, which is the power shares representing the NASDAQ market, the NASDAQ market continues to show strength, and although we pulled back just a little bit here on Wednesday, we did not come back to that 20-period moving average, and the divergence now is even wider. And not only that, but on Friday we closed on a gap up here for the NASDAQ. You don't see that too often where we have two gaps in succession here for the NASDAQ before they're filled. Right here, I think that the NASDAQ can go higher just like the Dow, set another high, and again, that's supported by the strong volume. But the wide divergence from that 20-period moving average is going to lead me to believe that we can pull back towards the end of the week, maybe Wednesday, Thursday, and or Friday. We can see a pullback towards the end of the week there. So I'm going to erase the volume line right there, and I'm even going to go so far as to forecast slightly higher volume, and then I think we're going to even start to drop in volume. Keep that in mind as you go over the videos that I'm going to suggest at the end, because when the volume starts to drop, that's telling us that the buyers are running out of that buying power. They're losing momentum, and you want to keep an eye on that. Volume is the best leading indicator outside of the VIX that you can find and track. Now speaking of that, the VIX, Volatility Index, ticker symbol VIX, we're right on historic lows for the VIX. Today, Friday, we closed right on the historic low. Now, we can go back 30 years and I can show you that that's the low. I'm not going to waste time doing that. You can do that on your own. But the interesting thing is we did move up on the VIX on Wednesday, and it spiked up over that 20-period moving average, but we didn't close over that 20-period moving average. So I think we're going to see for next week on the VIX, because remember, the VIX is a contrarian indicator to the S&P. If I think the S&P is going to go higher, then there's a chance that the VIX could go a little bit lower and actually break down below that support level before going higher. And I'm going to suggest that next week we're going to pop right back up as the markets start to pull back. Again, this volatility index could very much be affected by the elections in the UK next week. As investors show some uncertainty, they'll move to the sidelines. We might even see some selling, and that could, again, force the VIX to go a little bit higher. I briefly mentioned videos, and that would be found on the Market Guys page. If you go to themarketguys.com and click on the video tab, you'll see that there's a library of videos that we call market shots. I'd like you to, again, review the rubber band effect and what that means. It's the video second down on the right, and that's going to give you a short 7-minute video that explains the rubber band effect and the divergence from that moving average. I think it's something that everyone should know about, and you should also track that when you're adjusting your positions or even thinking about getting into new positions. Stay tuned to the Market Guys, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.